If you've ever tried to navigate the personal loan market, you know it can feel like walking into a store with no price tags. Everything looks helpful and sounds promising, but you don't actually know what anything costs until you sit down, hand over your sensitive personal data, and wait. By the time you finally get an offer, you're often exhausted and halfway committed. That approval rush is exactly what many lenders count on. If you accept the very first offer without comparing it to others, you risk falling into a high-interest cycle that is difficult to break. This chart highlights the gap between marketing and reality. Lenders frequently showcase a tiny 6 or 7% APR on their homepage, but compare that to these bars representing realistic APRs for scores of 750, 650, or 550. Those lowest advertised rates are typically reserved for the top 10% of applicants, borrowers with pristine credit histories, high incomes, and very low debt-to-income ratios. For most people, the actual cost of capital sits much higher. However, inaction has its own price. If you're carrying high-interest credit card debt, that compounding interest is actively working against your net worth every month. You need a strategy to lower that cost without overpaying for the new loan. Using soft pull pre-qualifications across multiple marketplaces allows you to see real numbers from several lenders simultaneously. It forces them to compete for your business without a hard inquiry hitting your credit report. Taking 15 minutes to look at these side-by-side offers is a reliable way to spot predatory terms and identify which lenders are actually offering you the most competitive rates. If your credit score is 720 or higher, you represent the lowest risk to a lender. Because they compete aggressively for your business, you have the leverage to secure high loan limits and avoid common fees. For this tier, SoFi is a prominent option, funding loans up to $100,000. This capacity is useful if you are financing a major home renovation or restructuring a large amount of existing debt into one payment. Discover and PenFed Credit Union are also strong choices here. They both offer structures with no origination fees, meaning you receive the full loan amount you applied for, rather than a percentage being deducted up front. But a high score isn't the only factor. This scale illustrates the debt-to-income ratio. Lenders compare your monthly income to your existing debt obligations. If those obligations stack too high, even an 800 score won't prevent a flat denial based on available cash flow. At this level, securing capital is about demonstrating a balance between your payment history and your verifiable ability to handle a new monthly payment. Borrowers in the 650 to 690 range are often focused on debt consolidation. While your history is generally strong, your profile might be weighed down by high credit card balances or a shorter credit history. LightStream is a competitive option for this tier, offering fast funding and rates that often beat the interest on standard credit cards.
However, look what happens when a derogatory mark appears. Automated systems prioritize a single collection over the actual score. If your profile shows a history of missed payments, lenders will issue an immediate rejection regardless of how high your score is. First Tech Credit Union and U.S. Bank are often more flexible. They provide options for secured or joint loans and tend to value an existing banking relationship over a strictly automated scoring model. There is a behavioral trap to avoid here. If you use a loan to pay off your credit cards, you'll suddenly have zeroed-out balances. You have to ensure you don't rack up new debt on those cards while you're still paying off the consolidation loan. Focus on addressing any derogatory marks before you apply. A clean profile makes it much more likely that you'll qualify for the interest rates that significantly reduce your total interest costs. If your credit score is below 620, you're in the rebuilder tier. Approvals are still costable, but you'll face a hidden tax in the form of higher APRs and fees that you have to account for. Lenders like Universal Credit and Upstart specialize in this category. They look at alternative data, such as your education or employment history, to help applicants with damaged credit qualify for financing. The biggest trap is the origination fee. On a $10,000 loan, an 8% fee is deducted immediately. That $800 disappears. You receive $9,200, but you must pay back the full $10,000. Lending Club and Best Egg offer a specific feature for this tier, direct creditor payment. Instead of sending the money to your bank account, the lender pays your credit card companies directly. This ensures the funds go toward your debt immediately and removes the risk of the money being spent elsewhere.
If you are rebuilding, calculate your net payout after fees. You need to be certain that the remaining capital is enough to actually pay off the specific debts you are targeting. After you're approved, you have to stay vigilant about post-approval costs. Missing even a single payment can trigger a late fee that equals or exceeds the interest for that month. These charges can quickly erode the savings you gained by switching to a lower APR. Also, check the prepayment terms. Most mainstream providers have removed prepayment penalties, but it's still worth confirming you can make extra payments to get out of debt faster without being charged for it. Start by checking your debt-to-income ratio and removing any derogatory marks from your report. Then, use a soft pull to see real numbers and carefully verify whether the lender charges an origination fee. Match your profile to the lender's strengths: SoFi or Discover for large, pristine credit needs, LightStream for mid-tier consolidation, and Upstart or Best Egg for structured rebuilding. Personal loans are complex, but accurately diagnosing your financial profile allows you to leverage lender competition and avoid fees that don't serve your long-term goals.